Hey guys, today is Wednesday, October the what? 15th. And we have about 50 minutes to go for the cash close. And I want to take a few minutes to discuss a sequence of trades here because I believe that how I adjusted and then eventually closed this trade could be helpful, particularly to newer traders. So anyway, at 9:54 a.m., and this is Pacific time, by the way, I decided that it would be a decent idea to sell call spread in the SPX. So I ended up selling this at 9:54, almost about 5 minutes of 10 a.m. for 215. And shortly after, the market dipped down to, so let me find roughly 9:15 a.m., 66. So it was around this point in the day. And purple candles designates obviously going lower and yellow going higher. So at that point, the market dipped down, okay? So as the market was dropping, the vertical call spread that I had on was benefiting from the move to the downside. So this spread went from 215 to roughly a little bit under $1. Now, closing out the trade is fine as long as you don't have any PDT issues, and I do not. But regardless of that, rather than closing out this trade, which would have been fine, I could have, let's say I closed it for $1, I would have ended up making 215 minus $1, so 115 bucks on this 10 wide. But rather than do that, I decided to buy the, where did I do here? The 6680, 6690. So I bought this, and I'm not saying that this was the optimal thing to do, but I ended up buying that for, I believe it was $1. Let me double check. Okay, so I bought that for $1. Okay, so what to note here is that rather than closing out the original spread, I converted this position into a condor. And again, I don't want to suggest that this was the optimal thing to do. I just want to go through the process here of what can happen when markets are volatile and you get swings both ways. So anyway, getting back to the position, now the position is a condor, which I have on for a credit. So the money is locked in on this trade because I paid $1 to purchase the 80.90 vertical. And remember the 85.95, I sold that for 215. So the worst case scenario here is that I make $115. Okay, so why would I do something like this rather than just close out the original spread? Well, the reason being is that, as I mentioned, there's some volatility in these markets, and then a few things can happen here, and here's one of them. I do nothing. The market closes in the sweet spot, so somewhere in between 85 and 90, and that means that this 80, that means that this portion of the spread, the 80-85, is going to close out for max profit, and this one will also go out for max value, which in this case would be worthless, which is fine because that's what I want. So if I get max value on the condor, then there's an additional $500 that I can make there. So rather than making 115, I give myself the possibility of making 615 because the market closed out in the sweet spot. Now that's a hypothetical. I don't know that the market's going to do that. In fact, we still have 45 minutes to go. The market's close. This spread does have, this condor does have some value. So what I did, rather than watching the trade possibly go out or the market go out outside of the boundaries of this condor, which means it would close somewhere below 66.80 or above 66.95, I just decided to sell it out, and I sold the Condor for $1.05. So again, what we're looking at here is the original vertical that I sold. I could have simply covered it for $1, which in most cases, or let's say you cover it for some profit. In most cases, that's going to be fine as long as where you covered it is a reasonable area to close out the trade, given the circumstances of what's going on at the time. Okay, so again, rather than close it out, I converted it into a Condor, and then subsequently, I sold the Condor for $1.05. So this brought in constructing the position this way rather than closing it out. Gave me the possibility to make some extra money. And as I mentioned before, if it closes in the sweet spot, which I don't expect it to do, but maybe now that I'm actually out, it will. So I get to be slightly annoyed by that and laugh at myself. Anyway, that provides possibilities of an extra $500. And anywhere actually in between 80 and let's say 95 is going to bring in extra money. An extra $100 per point, up at 81, at 82, 83, 84, with the max being somewhere in between 85 and 90. But rather than wait and hope that that's going to happen, which is reasonable too. If there's nothing necessarily wrong with that. If you have a reason to think that really that's going to provide the highest expectation, then yeah, let it go and sit it out for the remaining 43 minutes, or you can sell it for you can sell it for something else, which is what I did, and I ended up getting $1.05. Now, again, in best case scenario, max profit's going to be hundreds of dollars more, but I don't know, even with 43 minutes to go, I don't know that the market's going to close in the sweet spot, and I'm not expecting the roulette wheel to be particularly kind to me. However, with the type of volatility we've had the last few days, as I mentioned, I thought it would be better to leave myself the opportunity to make some more money should the market come back, which fortunately it did. And again, that was in my mind preferable to simply closing out the original call spread that I sold, the 85.95 that I sold for $2.15. Typically, this is going to be fine, but it's not. I don't want to say it's not necessarily something you always want to do. As long as you're thinking about why you're doing that as opposed to something else, then you're just going to leave yourself more outs, and they're generally going to be more profitable. They're generally going to be profitable outs. So something to think about. All right, guys, I hope that was helpful. I'll catch you next time.